Welcome back to Crash Labs. We're live in location in Kirkland Lake, but Cam's in beautiful Vancouver, and so it's me, Denis Laviolette. I'm here with Cam Currie. Really a pleasure to have Cam on the show. Cam is a senior investment advisor at Canaccord Genuity, and really a staple figure in the Canadian junior mining scene, period. So Cam, welcome to the show, and really a pleasure to have you on.
Denis, thanks for having me. I greatly appreciate it.
So Cam, why don't you give our listeners, I think I did a decent job sort of summing up your, that you're a senior investor advisor. What does that mean? So let's talk a little bit about you. How did you get into this industry, and what's your current role, and what does that mean? What do you do?
Well, first of all, I'm a senior investment advisor, but I'm a specialist in the metals and mining space. In today's world, most senior investment advisors are wealth management, and they're more plug-and-play ETF investors. What we've done is we've basically specialized in the metals and mining space because of my experience and relationships. I've had 35 years in the business, really the last 22 years specializing in the metals, and have very deep relationships and understanding. So what we found is a lot of people venturing into this sector lose a lot of money because they don't know how to buy stocks. Right? And so they just buy ETFs. But in the case of ETFs, for example, when you're buying a gold ETF, your primary purchase in that ETF is Newmont. And we would never own Newmont. Newmont is a non-performing producing senior mining company in our view. And so what we do is we tailor portfolios to meet investors' needs in the metals and mining space. And it's just a void in the marketplace, and people need a weighting in the metals and mining, and most people don't know how to approach that or find people that do it.
Now, you've been in this obviously a long time, and do you find that investors' kind of mandates ever changed when they look at getting exposure to junior mining? I mean, oftentimes it's a boom-bust cycle. Do you find that investors typically are looking for a trade? Are they looking for that explosive upside potential or that volatility that mining can offer in a positive way? Is that something that guys kind of use or people use as a sort of a reason to kind of venture in and pick up the phone and call you and get involved?
Well, it's interesting. The environment of an investor, the psychology of the investor that you were just referring to, is an investor of the past. Canada is a mining capital of the world, and yet there's very few people doing what I do because a lot of people left the sectors. And, for various reasons. You go back to everyone chased cannabis, crypto, digital. The sector has had a real absence or vacating investor arena for quite some time. And that's one reason why I've stepped it up. I remember being in the market in 2002. I remember 2000, the dot-com bubble, and people were calling me a dinosaur because I said, this is ridiculous. Nortel was 35% of the index, and everyone was chasing all the dot-coms. And so we were rolling up our sleeves talking to investors about buying gold companies at $2 an ounce in the ground, and they thought we were like, why are you doing that? Well, the rest is history. 2002 to 2007, there were 7 10 baggers for our clients. So the problem we have now is there's no audience. There's no money flows. In fact, we're getting redemptions in the funds these days. I talk to a number of the funds. I deal with high net worth and family offices and funds, and there's no money flows. And so what's happening is some of the great companies are being liquidated in this marketplace, despite gold at all-time highs, because money's chasing the shiny objects of, again, Bitcoin at 57,000 again. And so there's a real value proposition. But the problem is there's an absence of investors because everyone wants to follow everyone else and be where everyone else is. And so the investor you're talking about has been burnt and has left the sector. And so that's the opportunity. And, you talk about juniors. I don't really do a lot of junior companies, the exploration companies, until they actually get to something of a critical mass. We're more in the developer mid-tier or creating a mid-tier market because there's such great value there. You don't have to go to the needle in the haystack exploration companies. You can wait for the discovery, and then they have to raise money.
Sure. Recently we saw, just as a segue off of that, recently we saw Newmont divest in a lot of their core, I wouldn't say core assets, but a lot of their assets in their Canadian portfolio, largely that they ingested through the Goldcorp deal. Is that an example of an opportunity to create or manufacture sort of a mid-tier company out of some of those residual assets? I mean, and clearly they wouldn't sell things that are foreclosed. They're likely usually these assets have a few years left on them, whether it's Musselwhite or whatever. When we think about crafting a mid-tier, is that something that is that sort of an opportunity?
I mean, there are opportunities, but unfortunately, in the case of a couple of their assets, because I was involved with Kaminak, okay, the coffee project, which is on the block, and Goldcorp bought that. And then they decided they're going to redo the resource, and then Newmont got a hold of Goldcorp, and their social relations have deteriorated substantially. So the community support for mining up there has been impaired. So, but there's an example of buying an asset and putting it into another company. But in today's world, there's no money flows right now. And so there's no money flow. So even if you decide we're going to take that, and even if you're a seasoned mining team, you're going to take that. Now you're going to have to raise the money, spend the money, and trying to raise capital in the marketplace right now. I mean, literally, there's no new money. I call it cannibalizing right now. If you're going to buy something, you have to sell something.
Yeah. Now it's interesting because there's certainly been a vacuum in and as you said, a lot of the funds, the core funds that have been operating in this space, whether it be like Fidelity's Gold Fund or whoever it may be, a lot of the larger funds, let's say, have been facing redemptions. That's been the overarching theme, and they're sort of, they're getting gutted from the inside out on that side, and so they're not particularly throwing their money, splashing their money around. And if anything, they're taking it off the table, not putting it on. And we've seen this big shift as well. Like one of the interesting pieces I listened to was Pierre Lassonde and Frank Justra put together this piece on the pension funds in Canada, and how little allocation that they have in the actual Canadian investment landscape. I mean, most of these funds are invested and allocated their funds elsewhere outside of the country. And we went as far back as I think it was in the 90s, something to the effect of like 80 to 90% of those funds, those pension funds, were allocated in Canadian investments, and now it's 18% or something like that. And as far as mining goes, I think it's as Pierre and Frank said, something like under 3%. So that's awfully shocking. Is there a way of getting that money back in? And was that money like ever really into mining in the sense that we relied on that big basket of capital to sort of support our theses?
First of all, the answer to the question is yes, the money was there. But don't forget, we had Inco, Falconbridge, we had all these other assets taken over by companies outside of Canada. So Canada has become almost an uninvestable country because of our stewardship. And we've had capital outflows happening for years now. And so that's been a major problem. We are the mining capital of the world, and yet we have money not coming into our mining companies, partly because of the stigma of our Canadian investment arena. One of the things that Frank and Pierre didn't talk about, because I was talking with Frank about this, is in Australia they have what's called the superannuation funds. And that's a huge component of investing. So you have these superannuation funds that basically buy resource companies, resource investments in Australia. So they put their money where their mouth is in their own country. We don't have that. And partly it's mandated there. The other problem we have right now is that, Australia is not beside the United States. We're beside the United States. So Canadian investors are chasing, the narrative of stocks in the United States. And that's another sucking sound of money capital leaving Canada. But the big thing is that, go back 20 years ago, there were mining investors and speculators in the Canadian mining arena because there were rewards in it. And there have been a lot of rewards too. I mean, you look at Great Bear, for example, from 11 cents to $30. We've had great successes, right? Philo, for example, from $1.80 up to, $22. We've had some great successes. And so what's happened in the past when we've had some successes like that, if you go back in time, is it spurs speculative money back into the sector because people see that you can make some significant gains. But we've had some of these successes and you haven't seen that happen because there's an absence of money in the space. Now, I look at that as a great opportunity because what people have to realize is that everything's cyclical. And we see a vacuum of interest in our sector. So you can buy some great companies right now that are cheap because they're being sold because they're liquid, because there's redemptions in funds. So you don't have to go down to the junior situation. You can buy some developers and mid-tiers that are great value right now. And with the belief that eventually the cyclicality of our sector will happen and people will flow back into it. In the precious metal side, what I think is really frustrating for today's investor is that gold's near its all-time highs. The stocks continue to go down. Now, they probably go down because we've had such disappointments. I mean, Newmont once again disappointed. These guys have increasing costs, lower production. You look at a number of hiccups we've had in the mining industry. And then you've got the situations like Cobre Panama with First Quantum. These things hit. I mean, West African companies hit with the Niger democracy, and yet the narrative is very bad, but the reality is it's business as usual. But, it makes the area uninvestable in a lot of ways. Yet there's great value and great companies that are doing very, very well despite the narrative. So we've had all these hiccups, but we also have an absence of money. So it's just created this vacuum and decline in these stocks. And that's the opportunity. But you have to have patience, and you also have to have somebody that knows what they're doing in terms of choosing the companies that are the best values. That's the key thing.
Yeah, it's funny because I mean, kind of my sort of foray through this industry, and it's been rather short compared to you, but I've seen it all. At least I feel that way, and I've heard it all. Waiting for the discovery. When's the next discovery coming? We've got Newfound, we've got Philo, we've got we've had Patriot, we've had all these things. Like there's been all like NGX. There's tons of big discoveries that have been made. So not like I'm sorry, but the we need a big discovery to make things to bring things back to life doesn't work. And I think you can agree with me there. And at the same time, it's like we've seen sort of we've heard, well, if gold was going to go to 2000, then that was going to be the thing. And as you mentioned, the profits. We've heard the whole thing that mining companies suck and they're just bad operators and they don't make enough money and stuff. But then I look across the table and I go, well, or the volatility factor, right? And say, well, it's too volatile. It's like, well, Bitcoin is fucking super volatile. And so is everything else. Like on, like if I look at even Tesla's volatile for God's sakes, and look at the size of that. So the volatility is kind of not the thing. And then in terms of profitability, most of these tech companies that form the root basket of American investment holdings are not performing super well. I mean, a lot of these companies lose money, and that's all they know how to do. And so you can't really say, well, it's because mining companies aren't making enough money that it's not attractive. So I often wonder, what is it going to take?
And what's interesting, I've given numerous speeches on this, and it's very simple. It's called narrative economics.
Okay.
And so actually, David Einhorn came up with a podcast a couple of weeks ago, which I encourage everyone to listen to because he makes reference to the fact that markets are broken. And what he was referring to is what I talk about, and that is narrative. Narrative creates price action. Price action creates indexing and ETF flows. Okay, so let's look at an example with Bitcoin. Bitcoin is $18,000 a year ago, and all of a sudden they start talking about the ETFs on Bitcoin. And so now there's a speculation that Bitcoin ETF is going to happen. So of course, passive flows run into ETFs to buy Bitcoin. So there's the anticipatory move. Price action creates a narrative. Now everyone's talking about this. And, when they actually approved the ETFs on Bitcoin, I don't know if you saw that, but the SEC, when they had the press conference, they basically announced that they're going to endorse the ETF, but at the same time, they condoned Bitcoin as an instrument. So they facilitated the financial institutions like the Grayscales and BlackRocks because they were going to make money on this. Now, what's interesting, I'll segue into this on Larry Fink from BlackRock. $9 trillion assets under management, endorsed the Bitcoin ETF. He was being interviewed about 5 months ago, and you knew the direction of the interview was going towards the ETF on Bitcoin. So they're talking about the economy and, recession, no recession, what the Fed's going to do, interest rates, inflation, blah, blah, blah. And unprovoked by the interviewer, Larry Fink said, traditionally, gold has been a great alternative to fiat currencies. But the problem with gold is it's difficult to buy and it's difficult to store. And from there, we segued into the rationalization of ETF on Bitcoin. And so I've been actually working with, not working with, World Gold Council's initiative, but I've been talking to Randy Smallwood on a regular basis, ex-chairman. David Tate, I had a call with him last week for about an hour and a half. And the digital token of a gold, I'm going to call it crypto, is come down the line. And so you will be able to buy a digital token of gold. And when you buy it, it's sitting in a vault in Switzerland or England or in Singapore. And so it is coming. So the barrier to difficult to buy, difficult to store, a tangible asset outside of fiat currencies is coming. And if you look at the narrative of Bitcoin, it's a narrative that drives ETF flows. And I guess, Denis, the best example I can give you of how stupid ETF flows are in terms of they're always buying, not always, but they can be buying overpriced assets, is what happened in cannabis here in Canada. You know, the US investors couldn't buy cannabis stocks, but they could buy ETFs, and they were buying the underlying envelope of companies in the ETFs. And, you know, there were Cannabis, Canopy, Tilray. And most people buying those had no idea what they were buying. They thought they were buying a conservative ETF. Well, these ETFs are not price discriminant. So Tilray went to $260 a share. You were buying that ETF, you were buying Tilray at $260 a share. Now it's $2 a share. So what you're seeing in today's action, going back to what you're saying, is narrative economics drives price action, which ticks the algos, and the algos then get the ETFs flows. And, you know, CalPERS, which is California Pension Fund, they're saying now primarily their primary investment tool is passive funds now, because passive funds are what's driving the marketplace. And so that's why Tesla went to $700 a share, because of passive funds. It's $200 a share, but it still has a greater market cap of all the auto companies combined. So right now, AI, you know, NVIDIA, that's all everyone's talking about. NVIDIA jumped $268 billion in market cap in one day. Okay, the market cap of all gold mining equities on the planet today is $260 billion. Absurd. And no one's paying attention. But what's really interesting about this is that what's really twisting for us investors in North America is gold's near all-time highs. It's at all-time highs in most currencies. All these Eastern banks continue to buy gold. Eastern wealth funds are buying gold. The second best performing investment for Chinese investors was gold last year. And yet in North America, the gold ETF holdings have gone from 3,700 tons to 2,600 tons. So the ETF flows out of the ETF are the algos, the equities are riding. And so we have this liquidation in the equity ETFs. And yet the Eastern banks, the Eastern investors are basically saying, here's back the US dollar, which is impaired with 34 trillion in debt. And we want the tangible reserve currency. And that's what we want to add as our reserve base. And that's what's taking place. And yet, explain that to an average American, if you think about it, it's actually, well, what's my protection against my US dollar exposure? They should be buying gold and gold equities. But they aren't even thinking about that. They're buying the narrative of what's happening right now.
So what could we do then as an industry? I think we're responsible to do that. And I think I've taken it on in whatever way I can manifest with my podcast, with, you know, the media group. I've kind of taken on the kind of battle to say, okay, my sort of North Star with all this is I want to sort of shorten the learning curve for people to understand equity investing in the mining space, give them tools, arm them with information that makes it so that you don't have to be in it, lose a bunch of money just to understand how to read a press release on some of these companies or what some of this means. I really want to make sure that it's more accessible. That's my main thing. Accessible to younger audiences that don't have, let's say, the time or the attention, the ADD, if you want to call it that. They don't really want to understand these things too much. And so you mentioned the World Gold Council. Do you think from a narrative perspective that, like, what should be our job to put forward with that? Like, do you think we're doing a good job there? I mean, I've seen the commercials. They don't land for me. I don't know if that's going to help, you know. How do we, what's the message we should be sending? What's our narrative that we should be telling people?
Well, again, that's why, you know, as you, Denis, I'm very much an active person on this, because again, the sector has been left for dead, and there's no narrative towards the sector. There's a number of things. I think, in the analogy I give, this puts in perspective before I continue, is that you're in a stadium of 60,000 people, and the game's on, and down the field is Apple, Microsoft, NVIDIA now, you know, Netflix and that, and everyone's lined at the door to get into the stadium that's packed. And the gold sector is like 10 people up in the nosebleed section trying to get the wave going.
Yeah.
No one's paying attention.
No one cares.
So one of the things I was saying to David Tate is I think the World Gold Council should, because the epicenter of narrative is the U.S. market, U.S. media. You've got to tap into that. So I think they should have a greater concentration on that. I also think that they could collaborate with some of the people who are the spokespeople of the industry. You look at the Jeffrey Gundlachs, the Ray Dalios, the Druckenmillers, the Paul Tudor Jones. You have to have a critical mass of narrative for people to start paying attention. The perspective I give is if you're driving on the highway and you see a McDonald's arch and you drive and you don't see another one, you don't think of McDonald's. But after three truck stops, the fourth one, if all of them have McDonald's arch, you're getting hungry, you go have it, right? There's not enough consistency. And that's why I think they have to concentrate their marketing there. In India and China and Turkey and South America and Middle East, gold is an integral part of their cultural investment asset. We have to restore that in the United States. I mean, I was watching the Super Bowl and the woman who sang God Save America, she was dripping in gold. Now, if you were a gold investor and you had gold in your portfolio with gold equities, and you were to watch that, you would have an association with what she was wearing with what you own. But there's no connection whatsoever. I mean, these ads about, Coinbase, it's a gold standard in crypto mining, right? You're sitting on a gold mine when it comes to taking reverse mortgages. It's all around us, but there's no connection between gold as an investment asset class. I also think the World Gold Council should be doing a greater teach-in to the whole sector. So all the executives of the paying members of it should have a narrative consistent theme, because they're the miners of the reserve currency. And most people don't realize that gold is one of the top 3 reserve currencies in the world. There's the euro, the US dollar, and gold. And gold's the only one that has no political attachment, no debt obligation, and no printing press. And the miners of it have a market cap less than $260 billion.
Well, see that right there, sorry to interrupt you, but that right there, I think is the narrative that speaks to me. That seems to be the one that I would like to package up and broadcast to the world. And I know people try that, but I've seen a couple of people act on this. So one of them was like Minet, which was Roy Seabag and Josh Crump, where they had the 24K jewelry in the store and they could sell, and they were sort of marketing jewelry as, well, this isn't an alloy, there's no fancy gems in this stuff. You buy this jewelry, it's as good as an investment. It's ounces of gold in your vault, and if you want to sell it, we can buy it back, and and there's an exchange aspect to it. And that was kind of cool. So that's one group that tried it. Back to your point with Coinbase. I mean, when those guys did Gold Money and BitGold, I think it was BitGold, and then it turned into Gold Money, and Peter Schiff got involved. They went for that similar kind of theme. But I know that Roy and Josh took a way different approach, and they were ahead of this whole crypto thing. And in fact, I think they could have been Coinbase if they would have adopted crypto into their platform earlier. But I know that they were going to university campuses across the United States, and they were talking about fiat currency. They made cartoons. They were talking about fiat currency, what it means, what fungibility means, like what all this means, and sort of like why you should sort of be wary of fiat and how that fiat system came about and why gold matters, et cetera, et cetera. And Bitcoin was was a raving success at the onset. And I think that the crypto crowd came in and ate their lunch. I think they came in with an alternative thing that was singing to the same points. It was saying, okay, decentralization, all that.
I agree, but their audience was tiny, whereas Bitcoin was a global audience. And that's why what the World Gold Council is doing, although it's taking longer than I would have thought, it is a global platform. And that's why it's taking so long. You've got the LBMA, World Gold Council, all the bullion banks. Last September, they had the financial institutions, the HSBCs, UBS, Citi, Bank of America, JP Morgan. You need a buy-in of the institutions to embrace the product. Case in point, ETF of Bitcoin, because they've got to make money on it, right? So the foundation is being built. We just have to have it get to the point where it's going to get launched. And, what I've been told is it will happen this year. And, and if you think about it as an instrument, I mean, it's an asset class that makes sense. But the problem in America or in the Western world right now is that they haven't had any adversity of significance Every time there's been a hiccup, they bring interest rates to zero and the Fed floods the system and everything goes back on rails again, right? Whereas if you go to other parts of the world who embrace gold as an asset you own, it's not a speculative instrument, it's just something you just own. It's because they've gone through currency problems, government upheavals. And the US, whenever there's been a hiccup, they've just band-aided it over. And what you're seeing right now is these autocracies and BRIC nations and that are diversifying out of US dollars, and they're going back and they're buying the tangible reserve currency of the world, which has stood the test of time. And you explain that to an American investor, and they have no idea it's happening. But they just think, well, why do I need that insurance? And that's case in point. The ETFs have gone from 3,700 to 2,600. And I'm looking, like I look at like this past year, record low unemployment, which is surprising because again, the employment data, as far as I'm concerned, is misleading because a part-time job at McDonald's is not the same as somebody who's let off.
Completely agree. Yeah.
So the data again keeps on being misrepresented in my mind. But the bottom line is, they had a $2 trillion deficit in the United States last year with record low unemployment. You have interest rates, biggest percentage change in interest rates, still high. They got to refinance $9 trillion worth of their treasuries. When this US dollar starts to weaken, why would the foreign buyers keep on buying US treasuries in a declining currency in an increasing deficit position? We have another debt ceiling limit coming this Friday. The US is $34 trillion in debt. And when you look at Tucker Carlson's interview with Putin, for example, Putin calls out the fact the U.S. has $34 trillion in debt.
Yeah.
So the adversaries of America are telling the rest of the world, the Chinese and their basically the BRICS leadership and their globalization of ownership of commodities in the world. I can guarantee you they're telling the world that U.S. dollar, it's going to lose its purchasing power. I mean, they have to deflect from their problems at home as well. So all this is taking place, and yet the average American doesn't think about it. Oh, debt, it's been around forever. We don't have to worry about it. Yet you hear things like we're on an unsustainable path. You hear it from Jerome Powell. You hear it from everybody.
Everybody is.
And recently I listened to a Jeffrey Gundlach interview, and he's saying interest rates where they are right now, the Social Security and Medicaid programs, I mean, the interest cost is going to chomp away at or crowd out the money that needs to go to these fixed costs of America. So your deficit is going to keep on increasing.
Yeah.
So why would you want to keep on buying the fiat currency of the world, reserve currency of the world that's getting more and more impaired? And what's obvious to us, because we see it, is the Eastern investor and Eastern banks are saying, we want the tangible reserve currency. We don't want this impaired currency anymore. Now, how do you message that to an American investor? Because that's the narrative shift. Quite honestly, I think once reality of a recession happens, then I think the US dollar weakens. And if the US dollar is weakening, how do you attract funding for treasuries? You got $9 trillion worth of treasuries that have to be refinanced this year. Why would you continue to buy treasuries in a declining currency?
I guess something I don't know the answer to, and maybe you do, or you've given it more thought than I, but I've been trying to think about this because last time we had a boom, right, in this sector, it was on the backs of wealthy times. It was on the backs of a lot of people having cash in their jeans, global.
What era are we talking about?
Early 2000s, when global PMI was up. Governments were doing everybody was the bellies were fat and they were happy. I mean, sure, we had an implosion on the tech sector, but by and large, and I'm not talking about 2008 because it actually came before 2008. I'm talking about the 2003, 2004 run up to 2007. And
Denis, what that was a declining US dollar. The Dixie went from 104 down to 74. And so basically, people were losing money on US dollar ownership. So they were going to gold. And that's what took place.
But my feeling, I guess, the way I've been thinking about it, and maybe I'm wrong, is that my feeling was that the average person had more cash in their jeans. They had more slush money to invest. They had more to gamble. Do you think people this time around, like again, it's taken a long time for the reckoning to come to people that inflation's real and we are in recession and your grocery bills are double what they were and they're telling you it's some other number, but it's double and et cetera. Like, are we actually, is the money that people would have otherwise used in historic times to try to outperform or protect or whatever, is it gone? Is it wiped out? Did they lose it?
No, because that money's chasing all the narrative stocks in the United States right now.
Okay.
Despite higher interest rates, despite inflation, consumer inflation, you have money flows going into those. So don't forget, again, guys like Jamie Dimon and that remind people that with all the stimulus and the money they put into the system, that money's still flushing around.
It's there. Yeah.
And you have to understand, this is so important. And this is why I've been so adamant about, having a weighting in precious metals as an insurance policy, so to speak. When money was free for 10 years, global debt went from 200 to $300 trillion. Okay? Because money was free. And so asset appreciation created wealth effect. And as your assets appreciated, you could borrow more and you could leverage yourself more. And that's how we got to an increase of $100 trillion in global debt. So now we have these asset bubbles that, 2022 was the first crack, and then we've had this bounce back. Well, we had a bounce back in 2001, 2002 as well. And then it rolled over. And but what's different now is we have a new industry. AI is driving things. We have cyber software. We have cloud-based investments. So there's a new industry and great successes. I'm not being faulty of that, but there's a lot of industries. The stocks are far from their highs still, right? So we're in a situation right now where money flows are chasing the narratives of what's going on. We just need, like I said, cyclical. I don't know what the catalyst is going to be, but I still remember 2002 buying these things and no one was paying attention. And we were doing this 6 months ago here. And some of these stocks are down 30%, which, I've got one of my companies. They went from 50 million in debt to 110 million in cash. They went from 80,000 ounce production to 280,000 ounce production, trading at 5 times PE multiple. The other day, Shake Shack came out with earnings. They earned 2 cents opposed to 1 cent. So 100% increase in profitability. Stock went up $20 to $95 a share. Think about that. But the narrative and the algos and the quants pick up on these rate of changes, and boom, these stocks do what they do. They explode. And price action creates narrative, and narrative creates ETF flows. And think about that. Price action creates narrative, and narrative creates ETF flows. And that's what's driving. In the sector, our sector has no price action. Gold's at all-time highs, but there's no price action. And there's no narrative. The narrative is negative, and so you have price outflows.
So one of the things that was talked about with this whole ESG movement, and I think it's losing a lot of steam, certainly BlackRock and other groups have sort of turned away from embracing even the term. But one of the big things that was kind of tossed around early as it pertains to mining is that a lot of these big ETFs, a lot of these big funds were going to be mired from investing in the mining space due to the whole ESG principles of responsible investing and some of the restrictions. And there's this big push in the mining industry to be more ESG, or get their act together, so to speak. Do you think that's a thing? Is that restricting capital?
You could say the same thing about oil. I mean, everyone was saying, I think it was, which was it, BlackRock, or which one was it that said they were no longer investing in oil stocks a few years ago? Well, you would have missed out, right? I think that narrative is the past. I mean, just the other day I saw the largest windmill public company in the world cutting back their wind farms, and they just cut their dividend because money was free and materials were cheap. And so, if you look at how much money has gone into clean energy, and yet trillions of dollars has gone in, and yet in the last 20 years, use of oil and carbon fuels has gone from 83 to 82%. Right? So the ESG is a narrative, and that's what people think you have to do to tick the boxes in order to get the money flows. But I think it's getting more push aside. If anything, I think people have to realize that narratives can change. I mean, 2 years ago, uranium was a dirty word.
Right.
Now look what it is. It's a new safe energy.
Yeah, even Stéphane Guilbeault, our Minister of Environment in Canada, was like, what, Greenpeace, et cetera, et cetera. I had Jerry Butts on this podcast, right? And I asked Jerry Butts about nuclear energy. And he says on the thing, he says, I've always been an advocate for nuclear, always. And I couldn't combat him on everything, you know, but I had, there was a few softballs that he threw past me I didn't swing on. And one of the interesting things, so he says, well, I've always been an advocate for nuclear, but literally when he was the CEO of the World Wildlife Foundation, between the Dalton McGuinty appointment and the whole Trudeau puppeteering, he was literally like on the World Wildlife Fund that year. It was like dirty barrels of toxic waste oozing. Nuclear is bad and it's never going to get us there. Like you weren't always an advocate, or Stefan Guilbeault, Greenpeace, like ferociously against nuclear energy, and now celebrating the announcement of the Ontario Super, the new one, right? So he's all about it. So you're right. Yeah, I guess it can change pretty quick.
Well, that goes back to, you're talking about behavior being cyclical there. Markets are cyclical, and I would argue that right now in the precious metals arena, we're probably where uranium was 2 years ago, right? Citi just came out and said in a recessionary environment and deficit concerns, we could see gold going to $3,000 an ounce, right? So, and everyone looks at that and goes, yeah, right. That just looks so far-fetched. Well, I still can't believe we're sitting at $2,000 an ounce and our stocks are trading where they are. Mind you, we've had cost increases in that because of inflationary pressures. So the margins have been contracted. There's been lots of hiccups as well. But there's so many great companies out here that are so being penalized because of the sector liquidation. And that's the value proposition. So going back to the investors of today, not that I'm trying to, use this as a promote for myself, but you need to have somebody who understands the sector, who has the relationships. I have 30 to 40 clients who are geos and engineers. I do a lot of principal business. I talk to the funds on a regular basis. I have an inroad with the World Gold Council. I've got as many octopus touches than most people in the industry. And so trying to do it yourself is like trying to give yourself open heart surgery. You just don't know where to go, how to start. And if you just buy ETFs, like I said, you buy ETFs, you're buying Newmont, and I would never buy Newmont, right? So I think it's a very, very difficult sector to navigate because it is global. You have geopolitical, environmental, all kinds of risks out there. And so what people don't understand is that you look at tech, everyone talks about all these great success stories in tech. Well, no one talks about all these tech companies that have gone bankrupt, or from 5 billion to zero, or on Ether right now. Things are risky, but in markets that no one's paying attention, that have been left for dead, that's where you can buy some great companies and be patient with them, because when do you get a chance to buy things on extreme sale prices? But trying to convince people to buy some of our stocks right now compared to, well, what about Nvidia? What about Nvidia? What about Coinbase, with Bitcoin at 57,000? And Coinbase is back up to 205 right now, and they talk about being up 300% in the last 16 months. Well, it topped out at $425 2 years ago. So it's halfway from where it was, right? No one talks about where these things were. Peloton was $165 a share. It's $430 a share. Zoom is trading at $65 a share. It was $500 a share. So the U.S. narrative media shifts to all the new trends, and that's where the money flows, because that's what sells and that's what gets excitement going. And so it sends a message to investors that there's always something exciting happening, yet they aren't looking at the collateral damage of what didn't work.
So I guess in your business, just to speak to Canaccord a bit, obviously, and yourself, as an investment advisor, in this universe, and as you said, you're in the room, you're in the deal, and you can offer that to your customers so that they don't have to be buying Newmont or some ETF for exposure. We've seen a big shift of people, retail specifically, working with brokers, working with investor advisors, to getting Wealth Simple accounts, Robinhood accounts, and playing with their own money. That's certainly something I've picked up on. What do you think that looks like in the future? And do you think that trend, I don't want to say poses a risk to your business in that sense, but do you think that, how do you navigate that, I guess? How do you think about that?
Well, the biggest risk for transaction value investors is the creation of ETFs. I don't know if you saw, but I guess a couple of weeks ago, they just published that passive ETF funds now surpass managed money funds in the United States. T. Rowe Price just had $85 billion worth of redemptions on their managed funds because passive funds are outperforming right now, right? Because they're chasing narrative. And in a lot of ways, the narrative stocks are the ones that are overpriced because that's how they get once the technicals and the algos start picking up on these things, the narrative exponentializes them. Case in point, NVIDIA. Now, I'm not poo-pooing AI at all. I'm just saying that the narrative drives the money flows. And so if you look at most wealth management people today, they're just plug and play ETF investors. Very few are stock pickers. And so what's happening is now investors are just buying ETFs. Or their investment advisors are just buying ETFs. So the problem with ETFs is that a lot of times they have to have criteria for the companies to meet the ETF holding position, billion-dollar market caps, whatever the criteria it is. So where that is great for us is that we'll see companies that will come along that have a very material event taking place, but there's no money in the space, and the ETFs aren't buying them because it hasn't ticked the price action to get the algos to start taking the stock up. You know what I'm saying? So, I'll give an example. We were very fortunate to get involved with Philo when they had Lundin's staked the Vikunga district in 1996, and they had an oxide cap at Philo. Last drill of the season 3 years ago, they drilled 1,000 meters of 1% copper equivalent. Stock was like $190 a share. Stock didn't even move. And so I looked at that drill hole and I called up James Beck and Adam Lundin and I said, correct me if I'm wrong, but that's a game changer. You guys just hit the sulfides on this thing. He says, absolutely. Lucas Lundin came out, rest his soul, came out and said, this could be the biggest discovery in my history. And I'm thinking, Lucas has had many, many successes. And a statement like that, no one's paying attention. Well, the thing had a $200 million market cap. And it was the last drill of the season, so now they're dead news for 6 months. No one's paying attention. And there's no funds that are buying it because funds are always quarter after quarter performance. There's nothing that's going to happen.
Yeah, there's no development. There's no operating mechanics of anything here. Yeah.
Yeah. So I met with him 3 times, and the family put $20 million in. A couple funds out of Sweden put some money in. I put some money in at $1.85. And then for the next 6 months, I sat there and I was like 90% of the buy side because nobody was paying attention. And then drill program started up, and then they came through with Hole 41, which was an absolute game changer. And the rest is history. The stock now trades at $21 a share. So my point being is that, because ETFs and managed money is the way everything's gone, when things in the sector come along, in a sector where there's no money going into in the first place, there can be great advancements in companies and stocks don't move. Everyone goes, well, if that's so good, how come the stock went down? I've got 2 companies we just raised money for, and the principals were big buyers of both those companies 40% ago. And they've had such great success, but they've got to raise money to keep the advancing the projects. But there's no money, so they've been raising money at a cheaper share price. So they're suffering with their success.
I completely understand your advantage. That you'll be able to suss.
You have to have patience, right?
Yeah, those types of deals and have the vision and the understanding of the industry to navigate through that space, and the ETFs can't. So de facto, you could outperform them. The question I guess I have is like, what about people investing their own money on Questrade and Robinhood and this and that and the other thing, and opting not to get an investment advisor and all of that?
Well, and you know what? Those Questrade ads you see on TV these days, basically if you use Questrade, you forgo the fees. And if you forgo the fees, then all the charts show that the fund has just gone up and up and up. Well, interesting. A year ago, you didn't see those charts because the market was going down, right? But now the market's in this uptrend that they can have that narrative. And you have, these people in their 30s sitting around a fire pit talking about, well, you'd be stupid to pay the fees, right? Well, perhaps in ETFs, if you're buying the S&P and all that kind of stuff, you can do that. But if you're going to be coming into our space, you have to understand the industry. I mean, there's like 4 or 5 companies I really, really like. but they're in those dead zones of permitting and environmental studies and First Nation relations or whatever. And so they're 3 years of dead money. And the asset could be great, and you could sit there and look at their website and their promotional literature and go, "Wow, this thing's so cheap," but there's no catalyst, right? So you can go and do your own trading and investing without paying your commissions and that. But I would argue that for the minimal fee we charge, I mean, most people, when you look at wealth management guys who plug and play ETFs, they're charging a 1 year 1% fee. So, okay, pay that fee and you buy an ETF. Well, you're paying me a fee that's more than that, of course, but you also get my expertise and my knowledge and my team's knowledge, our Canaccord team knowledge. And so you don't know when all of a sudden you get a 10 bagger that comes along. Well, you're not going to get exposure to those type of 10 baggers by buying on Robinhood, right? Unless you're very, very, very lucky.
Now, for the age group of let's say 35 to 45 or 35 to 50, those are the earning years typically of a person's life. How do you reach out to that? How do you guys reach out to that younger audience and say, hey, we're better at this. Come to us and we'll help you. Yes, there's fees, but you're paying for a reason.
First of all, in a lot of ways, people have to be looking for the sector.
Okay.
That because those people of that generation are all, they're on the internet and they're looking at situations. They're trying to figure out. And so going back to it, there's no narrative drawing them to our sector in the first place, primarily. And if they were in the last year, they were frustrated and disappointed. So they've disappeared, right? So first of all, they have to be people that believe and think that this is something they have to take a serious look at. And so once they're at that point, I mean, what we're doing is we're just trying to educate people. And educating people, then they're going to see that perhaps that's the type of people we should be dealing with, right? And the biggest thing is that,
so putting out educational content, thought leadership.
Yeah, I mean, talking to Americans and talking to high net worth Americans, they sit there and some of them will agree with you 100% of what you're talking about, but they're just following the herd.
Yeah.
So going back to when the narrative shift and price action shifts, then I suspect then they'll be calling back 6 months later going, remember we were talking and I reached out to you. I mean, now I think things are changing here.
Yeah, now's the time.
Yeah. And quite honestly, I don't know, when that time, I mean, these stocks are extremely cheap. A lot of our companies are dirt cheap. Some of the companies are paying us 4 or 5% dividend yields right now while we wait, and they're growing their assets. And when the money flows come in, it's a very tiny equity sector. And when money flows decide to come in, I mean, if NVIDIA's market cap jump in one day is the market cap of our entire sector, what happens when people decide they need gold as an asset class and they have to buy gold equities? If Citi's right and gold goes to $3,000, these things are all going to be 10 baggers.
Yeah, ultimately, I think it's like the material world entirely. Like what happens when people have the revelation that the entire material world that makes everything, every gadget that you play with, all the gadgets for which these software companies are on and that you're investing in, everything like that. Apple, like you said, 5% of Apple's market cap equals the entire mining sector. It's like, what happens when they make that recollection, that come to Jesus moment of holy shit?
And then, so you think about that, like, you look at gold's application in medical field, in satellites, in technologies. It's the best conductor. It's unbelievable. These supercomputers are gold is the best conductor, right? All these different things. So eventually a narrative will come along and people will realize, yeah, all these technologies we've been buying at these horrific prices and that, they wouldn't exist if it wasn't for metals. I mean, copper, gold, people can say that all the gold that's been mined is above ground, so you never know if the central bank's going to sell, so they can rationalize supply side differences. Copper is consumed. And there's no new copper projects coming in the pipeline. I mean, Richard, before he stepped down from Freeport, made the comment that, they're going to see copper at $5 a pound before they do capital spends right now. So you look at, the copper production in the world and the absence of new projects being built right now. I mean, you need a new Bingham Canyon built every year, and that's not happening. I mean, the Vicuña district is going to be the next big district, and is that 6-7 years from now? So, and then on top of that, then you look at who controls the big copper assets, China and Russia. So they control the assets. So, it's copper is going to have a hell of a market at some point here, and then eventually copper will be that that technology metal. And when it gets branded with that technology metal, people go, God, I have to own this, right?
I think it's certainly like the most natural stepping stone. It's like the most natural bridge between the technology world and the material world. It's like they can understand copper. Lithium to some effect was the same, and we saw that things got a little crazy there. But copper, it's fundamentally there and it's real.
Jeff Currie, who's the Goldman Sachs analyst, I haven't seen him on TV a long time now, but I remember him declaring copper is a new oil.
Yeah.
Again, the copper stocks, still have good prices right now because, again, people are thinking that China is going to stimulate, or, it has a narrative towards it. And the precious metals, I mean, there's just zero narrative. And again, I don't mean to keep on going back to precious metals, but, I spent an hour and a half on the phone with David Tate from World Gold Council last week. And, these central banks in the East continue to buy. India continues to buy. It's culturally part of their asset class. And somehow we have to create the perception that gold isn't a bunker boy ownership in the United States. It's an asset class that diversifies your portfolio and has proven itself over the test of time.
Yeah, it's not a tinfoil hat, conspiracy theorist, weapon of the basement floorboards, right?
Yeah, like I'm not like some gold bugs are, and I call it I'm a value investor in the sector, but people they're bunker boys. I'm not that at all. I'm just saying that in today's world with $300 trillion of global debt and asset inflation, and now the burden of that debt is getting heavy with interest rates. I mean, the analogy I give to people is if you go climb a mountain with a backpack with 5 pounds in it, no big deal. All of a sudden, interest rates made the biggest percentage change in history. Now that backpack weighs 50 pounds.
Yeah.
There's a burden on you. And that's where we are with our assets right now. I mean, a year ago, Silicon Valley imploded, right? No one talks about the regional bank problems. Yet 19% of office towers in the United States are still vacant.
That's crazy.
Interest rates are where they are. But no one's, and the problem here is that you start talking like this. If you go into a party in Silicon Valley and you start talking like this, you're going to be standing by yourself in the corner very quickly because you're going to kill the vibe.
100%.
Everyone just wants to be in the vibe. And that's one of the things about these things these days too, these phones and that, is that people are bombarded with all these new exciting dynamic things and living almost outside of reality than dealing with reality, because reality isn't as fun as living in non-reality.
Yeah, it's definitely scarier.
Yeah. And also the other thing too, and this is really important, is now with all these betting apps and all these other, the instant gratification of the consumer and the investor, mining, you have to have a 2-3 year horizon minimum. Everyone's looking for what's happening tomorrow. In fact, an independent brokerage firm in the United States, which is the number one platform for professional traders in the United States, the number one trading vehicle on that platform today is trading call and put options on ETFs on a daily basis.
Yeah.
That's where the speculative investor has gone to.
They want that volatility. They want that instant gratification, that week-long trade, that day-long trade.
Our gold companies can do a great, all of a sudden, something like one of our companies has had 7 new discoveries on a district in Nevada. And yet the stock's down 40%. And the market cap of the company is 300 billion US right now. They have a $1 billion autoclave. They've got 15 million ounces. And they've had great success.
It's that dopamine brain. It's that dopamine brain, and I don't know, like, it's a tough one when you think that through, and
well, if you look at it, the masters of the universe being the Facebooks and all these, and I mean, look what just happened with Google AI and their wokeism trying to suggest that they should have an influence on people not being gendered, criticizing and that. And I mean, they've taken it upon themselves to think they should program how we should think. And they influence how we think. And so in terms of investor mentality, you can't tell me if you have a phone, you're not being influenced with your psychology on a daily basis by the behemoth tech companies. You absolutely are.
Well, even Elon Musk, which I'm actually a fan of, even Elon with Twitter, I mean, the guy would go on Twitter and tweet a couple of things, and overnight you'd see hundreds of millions of dollars of moves, and whether it be cryptocurrencies or or lithium deals or his own stocks, like, or Tesla. It's like, oh, he smoked a joint on Joe Rogan, fucking, like, in the stock tanks. And people go and mop it up and like, oh, it's just creating that volatility. He knows that. It's almost like game theory. Like, he knows that psychology, that volatility, that X factor of, like, keep it moving, keep it oscillating, keep it crazy.
Well, good news, bad news doesn't matter because Tesla is always in your mind. And therefore, you're always thinking of trading it, right? I mean, the master of it too is Donald Trump. As bad as a human being he is, he's always front and present. And so, as long as you're front and present, then people are attached to you, right? And that's what's happening in the stock markets these days. And it's like I said, I mean, you listen to the talking heads and they talk about this stock being up 300% and this stock being up 400%. Yet they don't remind you that 2 years ago, they're still down 80%. And so if you're sitting there, all you're hearing about is these huge gains on a repetitive basis. It's like driving along a highway and you see a McDonald's arch. You see 5 or 6 of them. When you get hungry, what do you do?
You're gonna pile in. Yeah.
Yeah. And that's the programming of the investor, because all they're hearing about is all these great gains, but you're not hearing about the losses. I mean, you start looking at some of the economic data that's coming out. I mean, it's just, but people, that's the problem. Value investing, it has lost its podium position, and so great value companies, because they don't have price action, aren't getting the attention, and they're cheap, right? And if they're cheap, then they're not performing. People sell them because they're not performing.
Yeah, they get it's the dopamine brain. They get impatient with it. Yeah.
Yeah. And then the fund's quarterly performances are very important, all these different things. And so by default, people are just passively buying the S&P indexes and that ETFs, which spray into the 35% ownership of the 7 big behemoths. And Apple's had 7 declining revenue quarters, and the stock still has a $3 trillion market cap because of the spray in of all these ETFs.
So, Cam, I mean, this has been a great conversation. I'd love to have you on. Is there something that, because I just want to be cognizant of your time, is there something that you can leave? Like, is there something you're watching right now in the market, like as a signal? Is there something out there that you're kind of paying attention to that maybe our listeners can say, hey, like on the sentiment front?
Yeah. Well, one of the things I'm monitoring on a very close basis is the ETF flows, because I really believe that the swing vote will come when the U.S. investor comes back in. And like I said, 3,700 tons to 2,600 tons in the last 14 months. Yet gold's at all-time highs because all these Eastern buyers continue to buy. At some point here, there's going to be a catalyst of some sort for the American investor going, I think it's going to be economic data, U.S. dollar decline. I'm not sure what the catalyst is going to be. All the catalysts are there right now, but they just aren't creating that price movement. But I think once we start seeing that happening, then you listen for the narrative. And that's again where one of my advantages is because I deal with a lot of corporates. I deal with the funds. I have a pulse on that sentiment shift. When I'm talking to people that are close to the ETF side of things, and I start feeling and hearing that. And when that narrative shift happens, I mean, if you get picked up on the narrative shift on uranium, Cameco 2 years ago was $12 a share. It hit $65 just recently. And that's the largest uranium producer. So I think the ETF flows, you have to watch that very, very closely, and listen for the narrative, critical mass, and price action, because that's what's going to trigger it. Who knows what the catalyst is going to be?
Uranium, I would almost lay at the feet, honestly. Uranium, I could almost lay at the feet of Nord Stream 2, of the Nord Stream pipeline. I'd say as soon as that happened, everybody went, what happened why the fuck is Germany in this position? Oh, and then it was like, renewables are great and you need lots of those, but uranium, and then all of a sudden uranium was cool again and everybody was okay with it.
Well, the other thing too is, don't forget, uranium was $35 a pound, and then the Ukraine got invaded by Russia, so all of a sudden all the perceived supply of uranium for warheads wasn't going to happen. And of course, Japan turned on the reactors too. And then Sprott bought up 55 million pounds of uranium, took it out of the spot market. So there's a number of elements there. In the case of the precious metals, what's taking place right now is telling us a very big trend of change. And yet it's not being paid attention to by the American investor.
It's a psychological thing. It's a psychological contagion that needs to take on, right?
Yeah. Like, again, $34 trillion in debt to the United States. They got to refinance $9 trillion worth of treasuries. And the foreign, like China and Russia, they've all been selling their treasuries. They're going to continue to. And I think at some point here, when the Dixie probably breaks the 100, and there's concern about recession and deficit spending, and the deficit goes from 34 to 37 trillion, interest rates are where they are, and the interest cost is crowding out money that should be going into Medicare and social, and that becomes a narrative. People are concerned about it. And I think the magnitude of this move, I think when it starts, is going to be dramatic, and I'll tell you why. Because the autocracies of the world want to do damage to the U.S. economy and U.S. dollar. I mean, China right now has a lot of problems, and if they can deflect attention from themselves back onto America and the fiscal house of America, that will deflect and help them. And quite honestly, if the U.S. goes to recession, they can say to their citizens, one of the reasons why we're having such a tough time is because the U.S. consumer is having problems now.
Yeah.
You know what I mean? So you look for those narratives, and that narrative creates a price action, and the price action will get people buying the ETFs. And right now, I mean, that will happen at some point. The sector right now has redemptions. There's no new money flows coming in. And so for a smart investor, this is the time to go shopping. But to try to convince somebody to buy the sector right now because there's no price movement is extremely difficult. But I made my biggest gains for my clients and myself buying when nobody else is. And that's the most difficult thing to do, but that's the best way to invest because you buy low, you sell high. Last time I checked, Jeff Bezos just sold $2 billion worth of Amazon stock.
Yeah, there's been a few haircuts taken here recently from some of the big dogs. Yeah.
Yeah.
Well, thanks again, Cam, and looking forward to seeing you. I'm not sure what next time. Maybe we can do this in person, Vancouver or Toronto, if you're ever coming through. It's been a great chat and loved having you on. So all the best and good luck in the value investing.
And thank you very much for your endeavor on this too, because again, it does take a village, and one day there'll be more than 10 people in the nosebleed section getting the wave going. There'll be a greater audience.
You got it. Let's hope. All right, man. Thank you. Cheers.
Thank you very much.
Yep. Bye.
Bye-bye.